Welcome to vTalkInsight, Market Drivers Daily for August 24th, 2026. AI, geopolitics, and long-end yields are colliding today, with fresh bond supply, new Iran sanctions, and tech sector stress all hitting at once. Let's start with how the AI trade is evolving as funding costs rise and equity leadership looks more fragile. The core growth story around artificial intelligence is intact, but the ride is getting rougher. Capital is still flooding into AI, yet leadership in equities is under pressure and funding is increasingly coming through longer-dated, higher-coupon debt. Compared with earlier this month, the narrative has shifted from pure upside to a debate over sustainability, balance sheet risk, and how much volatility investors are willing to tolerate to stay exposed to the theme. AI-linked equities have started to wobble even as fundamentals remain strong. NVIDIA shares are in their longest losing streak since late 2022, and the Philadelphia Semiconductor Index is more than 20% below its June high, with almost every constituent lower. Alibaba's record Hong Kong share sale, raising over $10 billion to fund AI expansion after a 75% profit drop, triggered a double-digit fall in the stock and weakness across China tech, underscoring investor concern about dilution and capex intensity. Under the surface, AI has become a major driver of credit markets. AI-related borrowers have issued around $220 billion of debt year-to-date, with some individual deals rivaling the size of mid-tier treasury auctions, and investment-grade spreads remain tight. Many of these issuers are still free cash flow negative and borrowing long-term. So AI credit now carries both concentration risk and duration risk. A sector-specific shock or renewed jump in yields would hit a large and growing slice of corporate bond benchmarks. On the cost side, the infrastructure build-out is proving more inflationary and capital-intensive than early narratives suggested. NVIDIA plans to raise prices on certain advanced chips and server systems by more than 15% as high-bandwidth memory remains scarce, with supply-demand imbalances reportedly as wide as 15-1. Demand for compute is still accelerating by about 20 to 25% in recent months. Yet compute capacity is the binding constraint. OpenAI is shelving some projects to manage resources, and local opposition to new data centers is adding political and permitting risk to the capex cycle. At the same time, real economy adoption is messier than the hype implies. AI in education is disrupting traditional curricula and leaving institutions unsure which skills to teach. Younger workers are increasingly anxious about entry-level jobs, and recruiters are reverting to live testing and referrals as AI-edited resumes blur genuine differentiation. Yet enterprise software and infrastructure demand remains resilient, with many now seeing AI as a tailwind for leading platforms rather than a threat. Against that backdrop, capital is clustering in AI winners across both equity and credit, while some investors look to more defensive, low-beta names as diversifiers, highlighting the need to monitor crowding, leverage, and policy risks around the AI theme. Geopolitics is delivering a dense cluster of risks centered on Iran, North American trade, and the grinding war in Ukraine. Each on its own might be manageable, but together they argue for a persistent risk premium in energy, agriculture, and selected supply chains. Markets are also contending with event risk around sanctions announcements and press conferences that could shift expectations abruptly and trigger bursts of volatility in rates and commodities. The Iran story is moving into a more confrontational phase. Iranian oil exports to Asia have fallen to near zero as U.S. naval actions and sanctions bite, yet some flows continue via ships running dark through the Strait of Hormuz, keeping attention on that choke point. Washington is preparing what officials describe as an economic D-Day, including secondary sanctions on countries trading with Iran such as China, India, and the UAE, and new measures against dozens of entities and digital assets, shipping, and oil revenue networks, all while Iranian inflation hovers near 80% and domestic pressure builds. For markets, the key question is how much of this is already priced. Oil has risen roughly 30% from earlier lows this year, and Iranian crude now trades at a premium to global benchmarks. But recent sanction headlines have produced only modest price reactions, suggesting participants had anticipated tighter supply. Even so, risks remain skewed to the upside if Iran retaliates against Gulf energy infrastructure, if new controls on the Strait of Hormuz or Red Sea shipping add to rerouting around Africa, or if fertilizer and fuel flows are disrupted, feeding back into global inflation and rate expectations. North American trade is under strain as well. The U.S. plans to raise tariffs on Canadian autos, auto parts, and steel to 50% from January, while Canada is preparing $20 billion of counter tariffs on U.S. goods, including dairy, steel, and electronics starting September 8th. The dispute currently affects only a small share of bilateral trade, but both sides signal little interest in negotiations before the U.S. midterm elections, raising the risk of prolonged uncertainty for autos, metals, and agriculture supply chains, and even complicating the scheduled review of the USMCA framework. In Europe, Ukraine remains a slow-burn source of geopolitical and economic risk. EU financial support, including a €90 billion loan through 2027, is now critical for Kyiv, which faces another difficult winter as Russian attacks threaten energy and water infrastructure, and as its population has fallen from about 41 million to 29 million. The conflict is accelerating demand for drones and digital warfare. Ukraine aims to deploy 7 million unmanned systems this year versus Russia's 10 million target, while the EU is expected to produce only around 1 million, exposing gaps in regional defense readiness and spurring partnerships between European primes and US AI and cyber firms. Against this backdrop, even traditional safe havens like Monaco are under scrutiny after a high-profile assassination attempt raised concerns about security for wealthy residents. Long-end yields remain the macro fulcrum, and today's moves are again being driven more by supply, fiscal questions, and term premia than by dramatic shifts in inflation expectations. The 10-year Treasury is holding above 4.7%, and the 30-year is around 5.25%, levels that markets are increasingly treating as part of a new equilibrium rather than an aberration. Yield curves are steepening globally, with Japan leading the move and the U.S. following, reinforcing the sense that higher long-end rates are a worldwide, structural phenomenon rather than a purely U.S. story. Several structural forces keep pressure on the long end. U.S. fiscal deficits remain large. Interest payments hit a record $85 billion in August and now exceed defense spending, and foreign demand for treasuries is waning as major holders such as China trim exposure. Heavy issuance adds to the strain, with roughly $69 billion in 2-year notes, $70 billion in 5-year notes, and $44 billion in 7-year notes scheduled this week, on top of a surge in long-duration investment-grade debt tied to AI infrastructure and rising global defense outlays. Policymakers are not absent, but their tools look constrained. The Treasury is exploring buybacks funded through its general account and shifting issuance towards shorter-dated bills, while high-profile comments and operations, such as the recent so-called Besant twist, are meant to signal discomfort with a disorderly move in yields. Many market participants, however, doubt these measures can sustainably cap long-end rates while fiscal deficits stay elevated, and central bank intervention in the Treasury market is seen as unlikely unless volatility becomes severe, leaving the 10-year increasingly driven by private capital rather than by policy settings. This backdrop creates a tension between bond and equity valuations. A 10-year yield approaching 5% is viewed by some as a pain threshold for equities, particularly long-duration sectors such as technology and AI, even as others argue that strong earnings mean stocks can coexist with higher rates. There is also a sense that certain levels might force a response. Several participants see 10-year yields in the 5 to 5.25% range, or a 30-year near 6%, as zones where official action or value-driven buying could emerge. But most expect any such response only if functioning in the Treasury market looks at risk. In credit, compressed spreads combined with elevated yields increase mark-to-market risk if selection is poor. AI-related and other long-duration issuers are now a disproportionately large share of investment-grade benchmarks, and many are still cash flow negative, amplifying concentration and downgrade risk if growth or funding conditions deteriorate. From here, the key signposts are upcoming data and communication. Core PCE, Chair Warsh's Jackson Hole remarks, details on Treasury buybacks and issuance mix, and any surprises from today's Iran-related press conference. Together, they will help determine whether long-end yields stabilize in a high but orderly range or break higher and force a broader cross-asset repricing. To wrap up, The AI engine is still driving growth, but equity leadership is shakier, and a growing share of the story now runs through long duration, higher coupon credit with meaningful concentration risk. Geopolitical tensions around Iran, U.S.-Canada trade, and Ukraine are keeping a floor under risk premia in energy, agriculture, and defense, even if markets have already priced part of the shock. Above all, long-end yields remain the key macro variable, shaped by heavy issuance, fiscal uncertainty, and only limited policy levers, with a 10-year near 5% emerging as a critical reference point for both bonds and equities. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.